Looking back, 2021 was an endless party for the entire crypto ecosystem. Never before in technological history had money flowed so quickly and easily. According to Galaxy Insight, in 2021 alone, the total capital poured into the global crypto market exceeded 33 billion. Names like Solana raised 314 million in Series C, Polygon 450 million in Series D, and Avalanche 230 million through private sales. Many other projects suddenly became unicorns, pushing the entire market into an unprecedented frenzy. But fast forward to 2025, everything has changed. The collapse of FTX, 3AC, and Celsius not only evaporated billions of dollars, but also made investors extremely cautious. The latest statistics from Exploding Topics show that nearly 90% of all crypto startups fail, and 10% of them don't survive their first year. It's not because they lacked money, but perhaps because they used it inefficiently. This is a golden time to sit down and look directly at the classic mistakes many Web3 startups have made when raising capital. So that one day, if you boldly start a business with a blockchain project, at least you won't repeat that path. And why wait for the future? Why not now? Sometimes small ideas can be the missing piece the market is desperately looking for. Raising too much money without a clear spending plan. One of the most common mistakes crypto startups make today is raising too much capital too early without a clear plan for its use. This not only makes investors doubt the team's financial management capabilities, but also makes the entire project development strategy unconvincing. In the current context, the venture capital market is becoming increasingly cautious. According to Galaxy Research statistics, total investment capital in global crypto and blockchain companies in CONE 2025 decreased to about 4.9 billion, distributed across more than 446 deals. Although this number is not small, what is noteworthy is that the number of deals increased, while the average value per deal sharply decreased, indicating that funds are focusing on small, clearly targeted investments instead of pouring money in indiscriminately like during the 2021 bull run. The problem here is not just a lack of planning, but also a misunderstanding of the nature of fundraising. A successful fundraising round is not just about money being transferred to the company's wallet. It's also a commitment to investors regarding progress, efficient use of capital, and the ability to generate equivalent value within a specific time frame. If too much is raised without specific milestones, the startup will put itself in a passive position, losing motivation to develop because they have enough money, and facing difficulties in raising the next round, because the valuation has been diluted and the product has not yet progressed. On the other hand, many founders also make the opposite mistake, raising too little capital for fear of being considered overvalued, or because they do not yet understand the scale of costs required to operate a proper blockchain project. With a few $100,000 raised and no specific financial plan, many projects quickly run out of cash flow after only 6 to 9 months. At that point, they are forced to find every way to raise capital, most commonly by rushing to sell tokens earlier than expected. And this often leads to serious consequences: loss of community trust, increased selling pressure on tokens, and a sharp drop in price, causing the project to fall into a death spiral from which it cannot recover. Let's look at the report from Chainplay on the GameFi sector in 2024. 93% of GameFi projects have died, with almost no users. 88% of GameFi tokens have plummeted over 90% from their peak, with an average lifespan of only 4 months. Without discussing the quality of the games, the biggest reason for this situation is the indiscriminate fundraising, but lacking a sustainable financial model. They only focus on marketing, but do not have enough resources to maintain operations, build products, or support the community. So, how to avoid this mistake? The first and most important thing is to clearly determine how much money you need and why you need exactly that amount. APL, financial plan for at least 12-18 months of operation, including personnel costs, product development costs, operations, auditing, marketing, and a buffer for contingencies is mandatory. Next, you need to break down milestones into quarterly periods, detailing what needs to be achieved in each phase and how much it will cost to implement. If you can present this transparently in your pitch deck, investors will have a basis to believe that the project not only has a vision, but also the ability to manage and execute. A successful fundraising round is when you not only receive money, but also maintain trust, commitment, and proactivity in the project's development journey. Lack of transparency in token design easily causes investors to lose trust. Tokenomics is the heart of every blockchain project. It is not just a token distribution table, but how a startup designs incentives for users to participate, engage, and grow with the ecosystem. But many projects treat tokenomics as something to just draw up, or worse, intentionally hide sensitive parts. The consequence is that even a small mistake in design or an opaque unlock can cause the project to lose all trust from the community and investors, which is almost irreversible. One of the most common errors is a lack of transparency regarding allocation and vesting schedules. Many projects do not publicly disclose the percentage of tokens allocated to the team, advisors, marketing, or private sales. No one knows when these portions will be unlocked either. This makes the community and investors concerned that the team might dump tokens at any time. This suspicion is not unfounded. In 2022-2023, the market witnessed a series of Web3 projects whose token prices plummeted by more than 80% within weeks after the team or investors unlocked their tokens. A typical case is CryoWar, an NFT game project that raised over $3 million through seed, private, and IDO rounds. The Seaward token was publicly sold via Selenium in November 2021 at a price of $3 million through seed, private, and IDO rounds. The Seaward token was publicly sold via Selenium in November 2021 at a price of $3 million through seed, private, and IDO rounds. The Seaward token was publicly sold via Selenium in November 2021 at a price of 0.028. But just weeks later, the price peaked at over 4 and then plummeted, losing over 80% of its value within a month after listing. The reason the community was outraged was not only because of the sharp price drop, but also due to the lack of clarity in the vesting documentation. In the white paper, the section describing the private round unlock schedule stated 10% TGE, then 90% monthly linear, a phrase that easily misled people into thinking that 90% of the tokens would be unlocked after only 1 month, instead of the reality that linear vesting extended for nearly 2 years. This ambiguity made investors feel trapped, especially in the context of intense selling pressure from marketing and staking funds immediately after the IDO. But the problem is not just about the unlock schedule. Flawed tokenomics from the root also kills many projects from within. Many teams design token allocation primarily for rewards, incentivizing users with airdrops, staking, liquidity mining, etc., without building retention mechanisms. According to a consolidated report by Nansen and DeFi Llama Data, in 2022-2023, the market capitalization in DeFi evaporated by over 75% from its peak, mostly from protocols that chose to pump TVL with short-term rewards but lacked long-term utility. The danger of opaque tokenomics is that when the token price does not meet expectations, no one, including the team, investors, and community, has the motivation to continue building. And when trust is lost, you will not be able to raise the next round of capital, no matter how good your product is. So if you are a founder, don't treat tokenomics as a mere Excel sheet. Start with basic questions. Who will receive tokens? When will they receive them? What is the reason for the token's existence? If the market is in a downtrend, will the current design lead to increased selling pressure? A good tokenomics does not need to be overly complex, but must be transparent, logical, and have long-term viability. Ideally, it should be publicly announced on the website or in the white paper, accompanied by clear vesting charts for each group. If possible, use tracking platforms like Token Unlocks or Trust Path for the community to directly monitor the unlocking process. Lack of legal preparation when fundraising, easily leading to trouble later. Most crypto startups and many international projects start with the mindset of being ahead of the law, rushing to issue tokens, conduct private sales, and then proceed with IDOs, IEOs, IFOs, etc., without any proper legal structure to protect the team, investors, or simply to prevent the project from being blown away by an announcement from regulatory agencies. And when something happens, everything starts to seem passive and reactive. But by then it's usually too late. In the US, the Securities and Exchange Commission, SEC, has been very clear. If a token has investment elements and an expectation of profit from others, it can be classified as a security. Famous names that have been visited by the SEC include Tezos, investigated in 2018 after raising $232 million in an ICO, and Block. One, the company that issued the OS coin, fined $232 million in an ICO, and Block. One, the company that issued the EOS coin, fined $232 million in ICO, and Block. One, the company that issued the AOS coin, fined $24 million for an unregistered ICO, despite raising over $4 billion. The situation is not limited to the US. Since 2024, Europe has enacted MiCA, short for Markets in Crypto Assets, a comprehensive legal framework for the digital asset market. In Hong Kong, authorities require all investment-oriented tokens to be registered or comply with review procedures. Even in Southeast Asia, countries like Singapore, Indonesia, and Thailand will begin to tighten fundraising activities through tokens, requiring projects to have clear legal status, KYC, AML procedures, and legal contracts between parties. Yet, many crypto startups continue to raise capital through private routes without contracts, sending USDT directly to the founder's personal wallet without binding vesting clauses, no SAFT, no SAFTIA, nothing to protect both sides. This not only makes investors concerned, but also puts the founding team at great legal risk when the project develops beyond the scope of individuals, especially if they want to expand into international markets, list tokens on centralized exchanges, or attract large funds. Another risk is receiving capital from individuals or organizations involved in major scandals. After the collapse of FTX, many related investment funds like Alameda Research, Three Arrows Capital, or smaller branches that had cooperated with them were caught up in investigations. Projects that had received funding from these funds are now also affected by chain reactions, from being audited, delaying listings, to having cooperation canceled with other partners due to interconnected risks. The solution is not too complicated, but requires founders to work seriously from early on or choose a suitable fundraising structure. Most commonly, SAFT, short for Simple Agreement for Future Tokens, or SAFT, short for Simple Agreement for Future Tokens and Equity. If raising capital from foreign investors, it is necessary to research registration sources, such as Rec D, Rec S in the US, or equivalents in the EU, Singapore. Prepare documents such as legal opinion, token classification memo, and register legal entity in a friendly jurisdiction such as BVI, Cayman, or Singapore, depending on development and listing goals. Additionally, serious fundraising rounds should be conducted through a company legal entity, not personal wallets, with clear contracts, regulations on unlock times, token transfers, confidentiality clauses, and dispute resolution. And if possible, work with lawyers specializing in Web3, because the difference between success and bankruptcy sometimes lies only in a legal line that was or was not carefully prepared from the beginning. A chronic disease in the crypto startup world is prioritizing hype over product building. Many projects spend most of their time and budget running massive marketing campaigns on Twitter, hiring KOLs, making grand videos, organizing AMAs, even buying views, buying trends, etc. But they don't even have a truly usable product or any metric showing that real users exist. This is a tactic we saw GameFi projects frequently use in 2021. In the short term, these campaigns can bring positive effects: increased followers, a vibrant community, and rising token prices if in the selling phase. But in the long term, when the hype dies down, what will be left? If there is no product, no user data, no clear value creation model, then no matter how much money you raise, the project cannot sustain itself. And that is what investors are particularly wary of today. According to the 2024 in Review Fundraising in Web3 report by Outlier Ventures in February 2025, the fundraising landscape has clearly changed. Capital flows into pre-seed and seed rounds increased sharply, while Series A showed signs of slowing down. Specifically, the average raw pre-seed value jumped to $2.5 million, up $282.5 million, up 28% from 2023, and seed reached $2.5 million, up 5.6 million. Conversely, Series A fell to $17.6 million, lower than the previous year. MS average of $17.6 million, lower than the previous year's average of $17.6 million, lower than the previous year Andy Saverage of $18.1 million. Outlier explains, after the market shock in 2022-2023, investors poured capital into early stages to hunt for high profit margins, while avoiding Series A due to macroeconomic risk aversion, requiring proof of sustainable traction, such as weekly active wallets, retention rates, on-chain revenue, and projects, must demonstrate the attractiveness of alternative fundraising channels such as public token sale. This is also why many large investment funds now require startups to have an initial prototype or testnet product before they consider investing. For some more serious funds, they even require projects to present on-chain data dashboards from platforms like Dune, Flipside Crypto. The problem is not about not doing marketing, but about doing it at the right time and to the right extent. Hype can help you attract initial attention, but only product and data can help you maintain long-term trust from investors, the community, and your own team. In conclusion, fundraising has never been easy, and in today's crypto market, it is even less so for those who are careless, impatient, or lack strategy. Having money in hand does not equate to success. In fact, if you raise capital incorrectly, choose the wrong investors, design flawed tokenomics, or fail to control legal aspects, that money will become a double-edged sword, pushing the project faster towards the abyss. In the increasingly mature blockchain ecosystem, neither investors nor the community are as lenient as before. They no longer just look at white papers or the number of followers on Twitter. They want to see a clear roadmap, a real product, real users, a token model that can survive multiple market cycles, and most importantly, a responsible team that keeps its promises behind the product. But it is precisely at this moment that opportunities for serious projects are opening up more than ever before. Many talented startups and many ambitious young people are venturing into this market. And if properly prepared, they can be pioneers in the new wave. Hopefully, through this content, you as a founder, a builder, or even someone nurturing an idea can clearly see the pitfalls and thorns that hundreds of previous projects have encountered. Not to be afraid, but to be better prepared. Not to falter, but to go further, more sustainably. Hope you enjoy this content. Don't forget to like, share, and subscribe to support us.